I'm going to get right into it. If you guys have questions, just go ahead and write them down. Um, it's been such an exciting time to trade lately, and I think what you really need, you want good plays, and you want to be able to find good plays, but you also need a really, really good strategy. So, the name of this presentation is How to Combine 3 Market Indicators with 1 Killer Strategy to Win Over 80% of the Time. And this is the good part, while paying almost zero attention to your trade. So these, as you'll see, uh, they kind of win automatically, and you'll see why here in a second. But let's get into it here. So to make money in the markets, it's very important to have great tools for market direction. So what I'm going to show you with these 3 indicators is what they're really tuned towards, what they're really made for, is sort of trying to be able to tell you when the market's going to change direction, or if you got some momentum and it's going to stay in the same direction. And it just kind of gives you the confidence you need to enter the trade at the right time. So I've been trading for over 28 years, and I'm going to show you some ways to consistently cash flow the markets on a weekly basis. So even though you're going to see 3 great ways to tell which direction the market's going or an individual stock, I'm going to show you something even more powerful, and that's how to make money even if your indicators fail, even if you're a little bit wrong. So this is a complete system. I really use it for cash flow and bringing in money every week. If you compound that, I'm going to show you how powerful that is. If your goal is to create wealth, if your goal is to build up your account. And the way that we want to do that, it's not just how much money you can possibly make on a trade. I think when we first come to trading, a lot of us, that's what we look at. Oh, we could make X amount on this trade if this move happens. As you start trading and as you stay in it longer, you realize the most important thing you can probably concentrate on is your probability of winning. What is the probability of the trade working out in your favor? If you work with probabilities that are in your favor, the math tells us that over time, you're going to win. Even if you lose on a trade today, or if you lose on a trade this week, over time, the probabilities are going to win out, and you're going to win on way more trades than you lose on. And the math just kind of takes care of itself. So we're going to use these 3 indicators to tell us when to get in on a trade and how to trade it. Timing is really important. So the first indicator, and you may have heard of these before, but you might learn some new things about these. So these are commonly used indicators. And what I love about common indicators is the market is kind of like a voting machine. The more people that think a stock is going to go in a direction, the more likely it is. If people think it's going to go down, they start selling, and it just exaggerates that trend. The same thing is true in a bull market when things are going up. So the first thing that the Bollinger Band will tell you is what the overall trend in the market is, but what it also tells you is where the relative highs and relative lows are. So I'm going to just grab my little pen here, and you'll see that there's a red line here, and that's the mean, that's the average. And that's kind of where the stock or whatever it is you're trading likes to get back to. These outer bands sort of contain that. So it'll tell you a relative low when it's kind of getting stretched to the downside. The amazing thing about Bollinger Bands is that they contain so much of the motion, so much of the movement of a stock. Stocks look really random, but as you can see, this is mostly contained here. So the 20-day moving average is used for the red line. That's the mean. And then the 2 blue lines on the outside are 2 standard deviations from that red line. So what's amazing, and Bollinger's still around. He's down in LA. He's still teaching. He's still creating trends, and he's a tremendous observer of the market. But what he observed is that 2 standard deviations tend to contain most of the movement of a stock. When a stock gets extended, and that can be on the downside, as you see here, it can be on the upside, as you see here, you tend to have a reversion to the mean. The stock tends to kind of head back towards that average. Even if the average is going up or down, it'll tend back to go back. It'll bounce back to wherever that red line is. It's kind of like a rubber band. When it gets too stretched, it wants to bounce back. So the math John Bollinger uses, he says that these lines contain 95% of the price action. That's kind of in theory. In practice, what I've noticed is it's more like 90%. You'll see little throwovers where a stock for just a really brief time will get outside of these. Whenever you see this kind of movement where it's a little bit exaggerated, that's actually a really good indication you're going to have a bounce back soon, because it's even getting more extended. What is really rare, and when you're just about guaranteed of a bounce back towards the mean, is when you see the stock or the index getting to the third standard deviation. That's a real extreme move, and you're almost for sure going to have a bounce back. The reason we look at these is for potential reversal points. Another really great use of Bollinger Bands is to determine periods of low volatility that could soon be transitioning into high volatility and vice versa. So when you see these bands and they're pretty extended, they're pretty wide, they've created a big bubble here, that's more of a high volatility. We saw it here, we saw it here. And then what will happen is the stock kind of mellows out and doesn't do much, and you'll see it neck down. And these little necks are little areas of low volatility, and they virtually always, if you take a look at this whole thing, you'll see that they always explode into higher volatility. So that's an indication that you're going to have some big movement when you have that little flat line for a little while. And you can see it where these bands come together here and here. You have it, and then all of a sudden you have a big move. And here, you know, it's been flat for a while, and all of a sudden this big drop down. So that's a good indication that something's coming. When used all by themselves, they're kind of a semi-effective indicator. I like them because what they do is they contain the majority of the stock's action. So you can tell when something's kind of getting to an extreme, either high or low. If something's gone up, like for instance, right here, and you didn't have the Bollinger Bands, and you saw that the stock took off here and started climbing higher, and you chase this thing and you go, well, it's going up, it looks really good, and you get involved somewhere in here, and without the Bollinger Bands, you could be setting yourself up for an almost immediate reversal. So I really like them because they kind of tell you the contained movement of that particular stock. So what I'm going to show you is if you just use these for directional trading all by themselves, and I don't recommend that, but if you do, they have about a 47% success rate. I'm going to show you, with the strategy that we're going to talk about here in a minute, how to get over an 80% success rate using Bollinger Bands. And of course, the other indicators that I'm going to show you actually help. And this next indicator is called the Moving Average Convergence Divergence, the MACD. Almost everybody's heard of this. A lot of people don't know how to use it properly. What's cool about the MACD is it's both a momentum indicator when something's going in the same direction, and it's also really good for telling you reversal points. When you use it in conjunction with the Bollinger Bands, it can be very, very effective. These are two indicators that are really cool to combine together. They tell you a lot. And we're going to kind of see how that's done, but it's very simple. It's just subtracting the 26-period exponential moving average from the 12-period exponential moving average, and that's where you get these lines. And the way that it showed as a zero line. You can see the zero line down here, and then you have these two moving averages. The fast moving average is the 12, the slower moving average is the 26. And they go on either side of this zero line, creating a histogram. And the histogram is these purple bars that you see here. We're going to see how to use those and kind of help us indicate which way a stock is going. So you look at the zero line, and obviously if it's above zero, it's bullish. Below zero, it's bearish. But what we're really looking for is turning points. And we're also looking for when these lines cross. So when the moving averages cross, a lot of people trade those. And my problem with the moving averages crossing is it's a little slow. So if you were to take a look at this and you see when this crossed and you went up here to where the chart is, it's already been going down for a while. So when you use a MACD indicator in conjunction with a Bollinger Band, you would already see that this Bollinger Band has hit the top end of its range. That's an indication we're going to have a reversal. And so you look down here at the histogram, and way before you see this crossover, you'll see the histogram starting to go down. So the histogram actually starts to go down. If you were to draw a line all the way up here, you'd see the stock was still going up. For a couple of days here, we just had a couple of green bars here, and the stock was starting to go down already. This is a really good place to take your position right here. And then it isn't until several days after that, or several periods after that, that the two lines actually cross. We're already at the zero line when that happens. And look at all of this movement that you could take advantage of. You could have gotten in right up here, taken advantage of all of this, and staying in the trade as it dropped down to the lower Bollinger Band. Once it starts down to the lower Bollinger Band, what you're starting to look for, and what this indicator is, well, we don't know exactly when a reversal to the upside is coming, but we think it could be happening soon. And that's when this MACD comes in. You see it comes down here, and as soon as it starts to turn, and actually, if you look at it, it's like right in here. So you have some early warning. It's 2 or 3 days before we see this big green bar and this big gap to the upside. So you can see how effective these two are in working together. It gives you trend, but more importantly, it gives you those potential reversals. So once again, this talks about the crossovers and when to use this. Definitely as a sell signal occurs when the fast line crosses through the slow line, but we can actually back it up and do a little bit quicker than that. And you want to get in on these reversals, obviously, as soon as you can, because you don't know how long the reversal is going to last. So it says, the MACD performs best during trending markets. I think it's really a great reversal indicator. But when you have these two lines, and they're kind of going parallel like a pair of railroad tracks, and you also have this histogram that's going up, never did reverse, it kind of still went up, and then it still goes up. That's a really good momentum indicator. So this started, this trend, this crossover, and this histogram when it started turning up was all the way back here. And look how many days you would have stayed in this trade. It never really reversed until we got right up here to this point. These are really good at indicating very closely to when these markets are reversing. And the momentum part of the indicator tells you to stick with that, to stay in the trade. So what we're going to do, and the strategy that I'm going to show you here in a minute, deals with options. If you haven't dealt with options a lot, that's okay. I'm going to kind of explain how this works. And we approach options a lot differently than most traders. Most traders will buy a call when a stock is going up, and they'll buy a put when a stock is going down. That can be an effective strategy. The problem is that your timing has to be absolutely perfect. And if you're going to be making money consistently, if that's your goal, is to make money every month and to kind of depend on that and seeing that cash flow rolling in and seeing your account build up, you really want something that's more mathematically in your favor. What we really want to do, and what we're doing with these indicators and the strategy, is we're stacking the deck as much as we possibly can in our favor. And if you do that, you can trade with a lot of confidence because you just kind of win the majority of the time. So what we're going to do is when we have a change, when we see this histogram starting to go up, and you can see it down here at the bottom, we sell a put spread. And I'll show you exactly how that works. But basically, we sell an option underneath where we think it's going to go. We buy another option to hedge, and that creates a really nice credit in our accounts. And the neat thing about it is we don't have to have a really strong trend for us to make money on this. In fact, the beauty of this is you can make money even if the stock doesn't do exactly what you think it's going to. When we start to get up towards the top and we see this histogram, this MACD histogram starting to turn over, this is a great opportunity to sell call spreads. And I'll get into the specifics of that in a moment, but I just want to reveal just real quickly before we get into it what our strategy is, because it gives us such a high probability of winning. You don't have to be so perfect. And that's what I love. So our third indicator that we're going to take a look at is on balance volume. So on balance volume is a really cool indicator. As you know, volume is really meaningful because it's the vote on a direction. So if a stock is taking a new direction, but the volume is really low and nobody cares, it has a very high potential of reversing because not that many people and not that much volume is driving it higher. Well, so what we want to know is how much conviction is in this direction. So the OBV, the on balance volume, takes it compiles all this information into a single indicator. And what it does is it measures cumulative buying and selling pressure by adding up the volume on up days and subtracting the volume on down days. So ideally, volume should confirm a trend. It should confirm a move. So a rising price should be accompanied by a rising on balance volume, and a falling price should be accompanied by a falling on balance volume. And if it doesn't confirm, then look for the trend reversal. And so here we have our Bollinger Bands on top. You can see those. You can see our MACD down below, but this is our on balance volume line. So here's how to use this for reversals. If the on balance volume line is trending lower, like this one is right here, what you're going to look for is an uptrend transitioning to a downtrend. That is your reversal. So here we have an uptrend and we get a high that's not as high as the previous high. So it's definitely trending lower. And then we go up here and this is our clue right here. And then we see that confirmed with the histogram just about a day or so later starting to turn lower. And that corresponds right about to this point here in the chart. So we know that a reversal is coming. We know that this thing is going to turn back towards the overall direction. What's interesting about this is you'll see the stock will make a new high, but the on balance volume does not make a new high. So even though the stock has made a new high, it's not an indication of a trend reversal. And this is what you really want to know. Just because the stock or an index has been going down doesn't mean it's going to continue to. So if it makes a new high and you're thinking, oh, we might have a real trend reversal here, take a look down here at your on balance volume for confirmation. At no time in this entire line of this on balance volume have we seen a high that's higher than the previous high. And that's really important because it confirms this downtrend. So in situations like this where you have a downtrend, what you want to do is you want to have something, the stock rising up to a point where your indicators are telling you that there's going to be a reversal, and then you take advantage of that with a trade. Let's get to our next screen here. So the on-balance volume has been trending consistently lower in spite of some pretty big intermediate term rallies. Once again, you can kind of see, here's the high here, and this is the high here. It's actually higher, but it's never confirmed by the on-balance volume. That tells you we're still locked in a downtrend, and those are the high probability trades. So this continuous downtrend tells us to sell the rallies as more downside is likely coming. And obviously the reverse is true when the on-balance volume is rising. And once again, what we're going to look for here is divergence. We've already taken a look at this. We're going to look for a situation where the overall on-balance volume is falling. As we can see here, even though we see a rise here, we look for that turnaround point where the overall trend reasserts itself. We have confirmation by the histogram actually peaking and going lower. And yet that whole time, the actual stock itself is going up. So we're looking for that reversal point. And there's a lot of money. You can see this went down quite a bit. And then we actually had a gap lower and it went down some more. And you would have this histogram turning where you knew when to get out of this trade. Really, really valuable information. And we can see the turning points. For confirmation of a turning point, look for divergence in price and also the MACD histogram. This MACD histogram is very valuable. Okay, so the beauty of these three indicators is they're not correlated. They work together to confirm a trend or mark a turning point in a trend. That's what we want. So the confirmation of a trend keeps us in a trade. The turning point in a trade either gets us out of a trade we're already in or helps us know when to initiate a new trade. When all three tell you the same thing, you've got an extremely high probability setup. And they work well for directional trading, but they work even better using a strategy that gives you a massive probability advantage. And so what is the best strategy to give you a massive probability edge? What is that killer strategy that's so effective you can make money even if you don't time your indicators perfectly? And if you've traded for any length of time, that you know that even the perfect market setups sometimes go awry. Some new information comes out, something different happens in the market, and we see a change in direction. That can be very frustrating to get stopped out of trades. So we want everything going for us possible. So the indicators are important, telling us which way a stock is going to go or whether it's likely to continue its trend. But what we need is an underlying strategy that gives us such an advantage. We don't have to be perfect on direction, and we don't have to be perfect on our timing. The trick to making money quickly and easily using these three indicators is to use a strategy that stacks the deck overwhelmingly in your favor on every trade automatically. So that's what we're going to do. And the way we'll do that is to use options because of their built-in probability of winning. And here's the key. And if you want to write something down in this presentation, this is a really important note to set aside, is we are going to switch from being an options buyer to being an options seller. And by doing so, and I'll show you the math here, we'll stack the deck instantly in our favor by over 80% on every trade. And that's just the math with taking no technical indicators or the chart or the trend or anything into consideration. So as we use these indicators and as we use these technical signals to ensure more probability on our side, our probability of winning goes up from the 80%. So here's a really good example of what we're doing. So this is on the SPX. So this is right after the election. So you can see there's this gigantic move higher in the market. Now, if we had our indicators up here, and just common sense tells you, don't chase this trade. When markets move as extreme as they do, there's probably going to be a reversal. So we were patient and we waited, and we had a couple of down days here, and it kind of looked like this thing was going to turn over. So what we did is we sold what's called a call spread. And what we're doing is we're selling the 6100 call. We're buying the 6105 call, and we got on this, I think we got 90 cents. Okay, so what that is, the difference between 6100 and 6105 is $5. So we subtract, we take our $5, the width of the spread, and we subtract this 90 cents. So this is our credit. This is money we actually get to keep. It goes immediately into our accounts. Now, if 90 cents doesn't do it for you, it's good for you to know that options come in 100 share contracts. And so this 90 cents is going to be automatically $90. That's the minimum you're going to get. If you were to do 10 contracts, you would get $900 into your account, and it hits your account instantly. So one of the things I love about this strategy is this finish line right here. So a lot of trades you get into and you don't really know when to get out. That's a big question mark. Well, come hell or high water, these options that we just sold are going to expire. We typically, the perfect point on that time decay curve is about 10 days. Now, 2 of those days are the weekend. So we're actually only exposed to the market for about 8 days, and we show the trade on a Tuesday. We get in Wednesday morning. It's really 9 days minus 2 days for the weekend. So our market exposure is only 7 days. And your time decay, and what time decay is when you buy an option, you're getting a certain amount, especially when it's out of the money like this. A lot of this 90 cents that you're seeing here, that's all time value. So logic tells us that unless this underline gets all the way up here to our sold strike, this 90 cents is going to be worth 0 at expiration. Well, the 90 cents hits our account right back here when we initiate the trade. And like I say, if you're doing 10 contracts, that's $900 hitting your account instantly. So to do the math on this and find out what we're making, $5 minus 90 cents is $4.10. And you divide the 90 cents of potential profit into your potential loss. And I think this comes out to about 22%. And that's about the minimum we're ever going to want to get on a trade. But I want you to think about something. That's 22% for just 7 trading days of time. It's going to be about 9 trading days of time on the calendar. But since we have the weekend, that's going to be just 7 days exposed to the market. If you were to get 22% or anywhere close to that, and you could repeat that over and over because of the high probability and the high confidence you have in these trades, some pretty amazing things are going to happen to your account. This is what I teach. This is what we do. I really believe in this strategy. I am in the market every single week with my own money. And we have subscribers that come on and they're still with us 10 years later because they don't want to go anywhere. And I'll show you some of the benefits you get and why that's the case. But if you had a strategy where with very minimal effort, setting these trades up it takes you about a minute or two. And once you do that, you let this time and time decay take care of itself. So let's see what happens. So we just did this trade about a week ago. The big election, we saw a spike higher, started to go over. And with our resistance line being hit and our other indicators, this looked like a good time to sell the upside. It was hard to imagine this thing to keep going higher. And it seemed like the market should really take kind of a rest here. So let's see what happens. Let's see what the follow through was on that. So here it is. This is where you saw these 2 lines here. This is where we sold our call spread. This is where we took in our, actually this was getting back to this. We took in 95 cents and just yesterday we saw this green bar here. So the fall had happened. We'd gotten right back down to support here, not only horizontal support, but uptrend support. We saw that our indicators were telling us that the market was starting to turn bullish. I didn't want this index to go shooting right back up. Probably wouldn't because it's pretty far away and there's not much time left. But just to make sure, and this is something you can do, you don't have to wait all the way to the end. We spent just 5 cents. That's what it cost us to close this spread, get completely out of the danger zone, and we instantly netted 90%. Why did it go from 90 to 5 cents in just a few days? Because the market had gone away from our spread. When it goes away from your spread and there's a very limited amount of time left, the value on this call spread just diminishes very, very quickly. Went from 95 cents to 5 cents. That's a no-brainer. You just buy it back, you free up your margin, and you chalk up a pretty nice win. So we've gone down here to horizontal support. We've gone to uptrend support. This is where the market is now. I just pulled this chart just a few minutes ago. And what we have another opportunity here is to sell for this expiration. And this is this Friday's expiration, another 90-cent credit. So that's pretty sweet. So we took in 90 cents here. We took in 90 cents here. In just a few days, this is going to expire, most likely worthless. We've got a nice big up bar today, and the market is starting to bounce. And the probabilities on this are just overwhelmingly in your favor for several reasons. One is the chart. The stock is heading away from your spread, which is really important. But the minute we put it on, I'll show you how statistically that's, we typically do 80% or better in our probability. But there's another factor that's really working in your favor. If you know anyone that's traded options or you've traded options yourself, you know the #1 killer of options traders is time decay. So you buy a call or you buy a put because the stock is trending and you think, I'm going to make all this money on this call or put, the stock's going to go in my direction and this is going to appreciate. Well, what happens sometimes is that trend kind of falters. The stock goes sideways for a few days and it's burning up time. And all of those days of time reduce the value of your options. That's the way I used to trade when I first got into options 20-something years ago. And I couldn't figure out why I was losing on so many trades. And then it just occurred to me, who is making money on these trades? Who's getting all the money that I'm losing? And it finally occurred to me, it's the options seller. The options seller has such an incredible advantage because time decay is on their side. So not only in this particular trade, not only is the stock going away from us, and it's starting to trend lower. But each one of these days represents a certain amount of time decay because there's only so much time value between the time we put on the trade and its expiration. We know that any out of the money call value or option value is going to be worth zero. And it's kind of an accelerated line of time decay, value decay, going into that last day of trading, that expiration. So you're putting just this huge factor on your side when you put time decay to work. Okay. So here's a setup where you can do this. I want to show you this because if you have a good setup, you have a good pattern, you have a good stock, you can kind of repeat and take several trades out of the market and actually make money in a repeatable fashion. So this happens to be on PanW, that's Palo Alto Networks. They're a cybersecurity firm. And what we have here is this big downtrend. And we saw this back in the September, October time period. And then what we have is a trend reversal. And we saw this on our 3 indicators, popped up, and then it popped to a new high, popped just above it right here. This gives us an indication that it's time to look at this. We got a big green bar here. So it's broken this downtrend. It's gone up on pretty substantial volume. This tells us it's time to sell a new call spread. This is a $2.50 spread. So that's 340 and then it's 337.50. So this is, here's 250 is the spread. And this is a very typical trade. This is why I'm showing you. This is how the math works. And what we got on this is 50 cents. So the most we can lose is $2 because that 50 cents is ours to keep no matter what. And so if you're making 50 cents on a $2 risk, that comes out to a 25% potential return for just 9 days of time, 9 calendar days of time. When you have a big jump up like this, it's a pretty strong indication there's going to be some continuation. This is what happened. It hit the finish line. We just let this one go all the way and we collected our full 25%. So we have the exact same situation that just set up here in November. We have this big downtrend and we have a gap higher. And because there's a range here on these 2 days, we entered our trade. And once again, we got another 50 cents for a 250 spread. And actually, this was because this dipped down, it was 55 cents. We got a little bit extra. We bought this back, somewhere in here. We didn't even wait till the finish line. And we bought it back for just 5 cents. And so we netted 50 cents on this. Actually, a little bit more. I think it was a 26% return because we're not dividing it. If we got 55 cents, that's just $1.95 was our risk. So this is a pattern that you can take advantage of. And one of the things that I want to point out to you is these really shot higher in both cases. But even if it would have gone sideways, we still would have made money. Take a look at this, and I want you to see the advantage that you have here and why this gives you such a high probability of winning. So we put this trade on right here when this jumped up. Well, so at this point right here, when you first initiate the trade, you don't really know what this stock is going to do. You have no idea. You have a guess. You're looking at the chart. The indicators are telling you one thing, but you don't know for sure. So once you put on this trade, there's only 5 things that can happen with this stock. We don't know which way it's going to go. It can go radically higher, which is what it did. It can go kind of higher. It can trend higher, but not really scream higher. It can go back and forth and it can trade sideways. Or once we put this on, it can surprise us and kind of go down a little bit. So in all of these scenarios, we win maximum profit if it goes up radically. If it goes up a little bit, we still get a win. If it goes up or if it just goes sideways, we still get a win. We make money on these trades. And even if it goes against us a little bit, we still get a winner. We still make money. The only way we can lose on this trade is if it goes down radically. And if it does, we enter a stop right here and we lose. It only costs us half. the amount of money as if the stock went all the way through both of our strikes. So this is a really good way to contain your risk, and you're going to win automatically on 4 out of these 5 directions. Okay, this is another one, and this is kind of a cool chart because it shows your indicators. So this happened to be UPS. UPS has been kind of weak lately, and I think it's shipping volumes are down a little bit. Their expenses are up. It's actually been a really good short. So when we saw this one hit the top of its Bollinger Band, which as you can see right here, hits the top of its Bollinger Band. And then we also saw, this is how you can see how to use these indicators, the MACD histogram turned over, and we have on balance volume that's actually heading lower. So every one of these indicators tell us, UPS isn't doing so good here. And we sold a call spread. This happened to be a, let's see, this is a so once again, this is a 250 spread, took in 57 cents because we got a little spike here. 57 cent credit leaves us only $1.93 in risk. This obviously turned out in our favor. It went along, we would have won anyway if it was just going along this line. But what we got is this just tremendous spike lower, which just sealed the deal. And we coasted into a really stress-free expiration. And this ended up being 30%. So we typically target 25% for just this short time period. And we can consistently get that. But oftentimes, the way we set these trades up, we get more. This is another one on the SPX. This is going back just a few months, but I want you to show how well these indicators work. So we have a trend. It's following a trend. It's doing pretty well. And then we have a break of the trend. So we have a horizontal trend line here. We have a break of the trend. And then we have where it's below the trend line, but the index starts heading back up and it touches it. And oftentimes, once it touches its new resistance line, we see a reversal. When we saw this touch, we sold a call spread. We got $1 credit, and it's a $5 spread. So that you take the dollar away from the $5, that leaves you $4 in risk. And this was an easy home run because the index just gapped lower right down to the bottom of that Bollinger Band. But you can see the indicators here. The MACD crossed over here. The histogram right at this point here, it turned from positive to negative. It dropped below the 0 line. And there was still a really nice credit for us to collect, even though we had confirmation that this thing was headed lower. So that was like an easy 25% in just our 9 trading days of time. Okay, how do we know we've got an 80% chance of winning or better? Well, one of the cool things about options is they're based on a mathematical formula. It's called the Black-Scholes formula. It's what made the options market, modern options market, possible. Before that, we didn't really have a mathematical formula for pricing options. So one of the cool things is when you start trading with me, and I really encourage you to get into this because it's so much fun to win the majority of the time. I show you how to set up your account. This is Thinkorswim. They're a great brokerage for trading options, very efficient. They've got good bid-ask spreads, very, very low commissions, and they've got a lot of analytical tools. So the layout that I show you is implied volatility, probability of being out of the money. This is a really important one in the delta. So on this particular trade that we did, this SPX trade where we sold this call spread over here, we look over here at what that was, what our strikes were, and we see that we had an 81.99%, call it 82% chance of probability of being out of the money. And that means that this index isn't going to be anywhere near our sold strikes at the time of expiration. Now, one of the cool things about this formula and seeing this 82% gives you a lot of confidence, but what gives you even more confidence is this is calculated not using any indicators on a chart. So this math just means that with the amount of time that's left and with the volatility on the SPX at this current time, and the distance between where we're selling our call and the SPX, we've got this 81.99% chance of winning. We don't really do a trade unless we have at least an 80% chance of winning. So once again, the probabilities are overwhelming in your favor just based on the math probabilities. If you start factoring in indicators and selling in the opposite direction of the trend, your probabilities of winning just go through the roof. This becomes a really stress-free way to trade, and a way to trade where you never have to worry about your exit because expiration is coming, and that's kind of taken care of for you. If the cost to close the spread gets down to just a few cents or 5 cents or just a really small amount of money, close it. It frees up your margin and you chalk up a win and you don't have to worry about it anymore. Okay, here's another one. This is Estee Lauder. Estee Lauder obviously was not doing really well for several months here. And we collected a 51-cent credit on a $2 spread. This happened to be a $2 spread. We sold the 104 and bought the 105 to hedge. So we just had a $2 spread in there. And we got a 51-cent credit on that. And that left us a $1.49 potential risk. That's a 34% return. Once again, 51 cents doesn't light your fire. Keep in mind that that's on 10 contracts, that's $510. 20 contracts, that's over 1,000. And once again, using our histogram, we can see that this trade is definitely trending in the direction we want. We did get a pop higher. It broke the downtrend line, but you can see that it immediately reversed. And this one expired at full profitability. And that's what just tends to happen most of the time. If you're sitting there asking yourself, well, you're just, all you're seeing is winning trades here. What happens when a trade goes against you? That's a good, valid question. If this would have continued higher, and you see here, if we would have gotten follow through on this and it would have touched our sold strike, we simply automatically, I'm going to show you how to enter automatic orders. We close the spread at that point. And we take a loss on that, but the loss is fairly contained. It's like I say, it's half of what it would be if it went all the way through, and we have automatic orders there, so you don't even have to watch it. It's a kind of a time-free and stress-free way to trade. This is an example of the rut, the Russell 2000 just blasting higher. We saw this reversal here. We saw on the MACD this starting to go down. We saw that this actually got outside the second standard deviation. We know that that's going to reverse pretty quick. That's exactly what happened. We sold the spread and we got a $1.11 credit on a $5 spread. So $5 minus $1.11 is $3.89. That's a 29% return in just actually a few, this happened to be just a few days at a time where we collected this credit. And our indicators helped us have the confidence to sell this credit spread when the thing was actually, jamming up quite a bit. But as you can see, it kind of fell off. And that's all it takes. It doesn't have to fall off dramatically. As long as your sold strike isn't touched here, you're going to win. Okay, so the odds of winning on this strategy are extraordinary. The indicators just help you. You're not completely reliant on them because as we've seen, the trade can actually go against you a little bit and you can still make money on this. So once you enter the trade, you just enter a stop right where I'll show you, which is right at the sold strike. You walk away knowing you have over an 80% chance of winning. And even if you don't win, even in those occasions where that doesn't happen, your potential losses are cut in half when you close it right at that sold strike. And we'll do that automatically so you don't have to watch your positions. So not only do you have an overwhelming chance of winning, but you get to enjoy a pretty carefree lifestyle as well. In fact, listen, if you're watching right now and you want to know more about this, you want to investigate this strategy, you think that this is something that you'd like to check out, I want you to get a free ebook. So you can go to carefreeprofits.com and you can see it's right down here. I've got it written down for you. Carefreeprofits.com. All you got to do is enter your email and I'll email the book right to you. It's a short little book. It explains credit spreads. It explains why they work so well, why they're stacked in your favor, why it's kind of an automatic way to win most of the time. And then in those situations that don't work out, instead of worrying about it or worrying about what could happen, you just enter these automatic orders and the spread just gets closed with or without you. Just happens automatically. So go to carefreeprofits.com, free ebook. I want to send it to you. And also I'll give you an opportunity to get our free letter that comes out late Tuesday nights that shows you how our trades performed the week before. I want you to see that. These are real trades, up to date. I'm in every single one of them. And I want you to see how well they perform. And I'll tell you what wins and what loses. You'll get a complete free part of the letter. And if you want to subscribe, you can get the entire letter, which shows you our 2 new trades for the week, the ones that we're doing going forward. But if you want to get the free ebook, see the strategy and see how well these trades work every week, go ahead and go to Carefree Profits and you'll get to actually see for yourself. So really worth investigating. So we target 25% per trade, and we're pretty good at that. Sometimes we get more. Lately, we've been getting more. But what kind of an attainable return can you expect over time? And what I like to do is kind of get in the real world here, because everybody paints these big, beautiful pictures. But what's your real return like? What are things, what can you really realistically expect to happen? So what we do is we don't trade typically, and this is what I advise, is don't trade your entire account. Have a little bit of cash set aside for rollouts. Every trade doesn't work, so there's going to be losses. Sometimes you have to factor those in. This is a little cash set aside, and we use those for buybacks. So if you're not using your whole account and you sustain some losses in there with all your winners, what can you expect to make in these time periods? We typically are in a trade for 9 trading days. If you want to extend that out to be conservative, you can call it 2 weeks. So is 20% more realistic? 15%? There's a lot of my people that are making a consistent 10% every 2 weeks. But I want to show you the power of this strategy and the power of compounding returns and what you could potentially make. So what I'm going to do is I'm going to take that percent of return every 2 weeks down to just 5%. And this is an amount that I know anyone can make, even if you're not having very good luck. If you have a built-in probability of winning on over 80% of your trades, I think, and you're targeting 25% per trade, I think you can count on at least getting 5% every 2 weeks. So let's see what that looks like, starting with just a $10,000 account. What does that graph look like? Okay, so this is the power of compounding. This is if you didn't take any money out. As you can see, we start off at 10,000 here, and we're just getting 5% every 2 weeks. We're not even talking about 25% or 20% or some of what we're typically getting. We've lowered that all the way down to 5%, and these are 2-week increments. And after 2 years, this is a 2-year graph, your account's grown to $104,000 and you're bringing in over $10,000 per month. You know who this strategy is really popular with? People that are retired. When you are in a position where you need passive income, and that's really important to you, you can get involved in dividend stocks, but they typically pay 5% a year. Can you imagine if you could do something that was kind of simple, straightforward, stack the probabilities in your favor, and automatically exited you when things weren't going well, so you didn't have to worry about it? And you had the potential of making 5%, not per year, but every 2 weeks. This is what happens to your account. Now, I know that there's no graph that's ever this perfect in the real world. But what we're typically seeing is, you'll do a little bit better, then you'll do worse. And your results in the real world are kind of a jagged representation of this graph. So it's going up and down, but in an upward fashion. And in the real world, this is more like what things look like. And it's pretty inspiring. If you've been a little bit frustrated with your trading, take a really good look at this, and I hope you get involved, because what happens is you start creating an expectation of winning, and that's because you win naturally most of the time. It's not because we're so fantastic, it's because the strategy is fantastic. Okay, so there's just one problem. You can start this yourself, and you can do this. I encourage you to get my free ebook. It'll really explain how to do it. But you can do this for yourself, starting with as little as $200 per trade. There's just one problem, and this is what people typically run into. If they don't exactly know what they're doing, if they don't have good guidance, sometimes they zig when they zag, should have zagged, they sell calls instead of puts. And whatever it is, they make some little minor mistakes and they don't do real well right off the bat. And if that happens, sometimes people get discouraged and quit. So that'd be a shame. I don't want that to happen. I want you to have the best guidance you possibly can. I want this to be a cash flow strategy you can do for the rest of your life. There's three big advantages of this to trading this way. You have a very high likelihood of winning, and the hands-free nature of the trading, and the tremendous compounded returns over time. Three huge advantages. And so once you start this, if you put a little bit of effort into learning it, and I'll really help you every inch of the way there, I think you're going to love trading this way. It takes a lot of stress out of your trading. So to make sure you start off profitably and stay that way, I put together an educational package that's the best anywhere for this strategy. And it's at a fraction of the $2,500 sales price we used to charge. I used to sell this. There's times that I've actually sold this even on cruise ships, in the Mediterranean. It's been a lot of fun. I've sold it. I've presented this at international conventions. I still have people that paid that $2,500 price and are still trading it, and I still get emails from, and they love it. It's a great way to extract market money out of the market every week. But I put together a really nice package here that's way, way better. I've added so much over the years to this, so much value, and it's not nearly at that price level that it used to be. So this whole package is called The Winning Secret, and it includes, you start off with how to trade credit spreads for fun and profit, shows you step-by-step how credit spreads work, why they work so well, and how they can work for you, how you can set your trades up to automatically win. This has a 161-page downloadable ebook. You get a 10-chapter video series where you can see and hear exactly what to do to start generating this income. You could get this package and actually start this week. That's the beauty of it. We have expirations that are coming every Friday, and you can take advantage of that. We just yesterday sold some spreads that are actually expiring this week, and also for next Friday. So you'll also gain access to archived webinars and video tutorials so you can discover new strategies and ways to improve your returns and limit your risk. And you'll also have access to all new additions for life as an owner of the package. So this educational part, this educational package, I'm going to combine two things for you. I'm going to combine our complete educational package, and I'm going to combine that with the subscription. So you get a really, really good deal on the subscription to start off. But the cool thing about the education is you pay for it one time, and you never pay for it again. And we're constantly adding things to it, new strategies, new ways to improve your odds, and you'll never pay a penny more once you get involved. One of the coolest things about this package is I show you how to set up automatic orders with our favorite broker for spread trading. And I call these money traps. And whether you have time to watch the market or not, you can set your trades up sometimes the night before, collect your credit. I encourage you to watch the market in the morning because you might even be able to collect more than what we suggest. But all your exits, I want to be automatic. So either the credit's gone down so low that you can just get out immediately by buying back for a very small amount of money, or you just let the thing go to expiration and it expires at maximum profit, or those rare circumstances where the trade turns against you. And in those circumstances, I want you to get out instantly without even thinking about it, without even knowing about it. And I'll show you how to set up those automatic orders. Now, this is the really cool part. This is where the rubber meets the road. This is where you're going to make some money. I'm going to include with this, and it's only $97 a month. I mean, you'll make the year's cost of this. You could make it back on your first trade easily without doing a lot of contracts. I mean, think about it. If you do 10 contracts at $1 a piece, that's $1,000 coming into your account with your first trade. It can potentially. So the market's going to pay for your subscription, but I don't even want you to pay for your first month. So get the educational package, which includes a lot, and I'm going to include your first month for free. But what this gives you is you get 2 trades per week. I give you one that's more conservative. It's usually on an index, and you can do in a Roth IRA. So all of this buildup, all of this money that you're making is completely tax-free. And I'll show you exactly where to sell your spreads and exactly how to sell them for the possibility of maximum gains with minimum loss. And I spend a lot of time looking for the right trades. And I have a lot more indicators that I use than just those three that you saw. I use money flow. I take a look at the strength or weakness of that particular industry. I look at on-balance volume. I look at a lot of indicators before I present a trade to you. So you have really two really good trade setups. They come out late Tuesday evening, and you can place those trades Wednesday morning. As an extra bonus, you're going to get a 10-module video course specifically on trading the weeklies. The weeklies are the best thing that ever happened to options since they were invented. Weeklies started to appear around 2012. Ever since then, they keep adding. Most of the major indexes have weeklies. The S&P 500 now has 3 expirations per week, which is really, really cool. So we have a lot of opportunities. It's really changed the options game. And when you're a seller like this and the odds are stacked in your favor, it's even more beneficial. So here's the thing. Most of the time you sign up for something and you're hoping it's going to work out. You like it, whatever, but you're not quite sure how to do it. So this is Deanna, and she's going to walk you through your package, one-on-one orientation, just you. She can see your screen. She'll show you what to click on, where to go. Make sure if you don't have an account set up yet, she's going to show you how to set up your account, how to get the right clearances, how to take the best advantage of this information. I really believe in one-on-one attention. I think that's really, really important, instead of just expecting you to figure it out on your own. And this is what really makes this attractive. You get a personal one-on-one coaching session. This is Alicia. She's really good at what she does. She was a finance major in school. 45-minute personal coaching session. It's tailor-made to your learning pace, exactly what you want to learn. We sell 3-session coaching packages and 8-session coaching packages. And a lot of the time people will get these 8-session coaching packages back to back. Is it because they have a hard time figuring out how to do the strategy? No, not at all. It's because Alicia's very good at helping people make money. And I think your first coaching session, you'll see your value. And maybe, that's more of a learning session, but she's really good at looking for trades, showing you how to find trades, showing you how to get in at the right time, and how to really maximize the strategy. She's fantastic. Options training coaches are typically $5,000 for a package. We're not anywhere close to that level in terms of cost, but our value, I think, is better than anybody. And in this package, I'm giving you your first coaching session for free. So we're going to include all of this. Go to worryfreeprofits.com to take advantage of everything that you've seen here. You get your first month's free. You can actually make trades, pay potentially for your subscription for the year. The package you get, the educational package, it's got everything included, and it's a one-time fee. You get your coaching session, you get your orientation with Deanna, coaching with Alicia. You get my 2 trades that come out every Tuesday evening that you can place the next day, and you get all this education so that you can really do it with confidence. So that's the package. It's I want you to go there, Worry Free Profits, so you can see everything you get. It's about $1,500 worth or more. You actually get more than when I used to sell it for $2,500. This one is, I'll just tell you up front, it's such a good deal. It's only $397 for everything that you see. And that includes your first month, and it includes all the education, your coaching session, everything. We've never put a package together that includes so much. We have about 2 minutes left. My time is pretty much over. If you've got a burning question, or if there's something I can answer fairly quickly, I'm willing to do that. Otherwise, David, do we need to move on, or what do we have?